Did you know that 92% of the world's money isn't even real? It's just numbers on a computer screen. Banks literally type new billions with a single keystroke. School never taught you how this game is played, but I will. Let's dive in.
Okay, so you probably have a few hundred, maybe a few $1,000s in your bank account right now. Well, across town, a hedge fund manager just made that same amount in the time it took you to blink. And somewhere else entirely, a government just created $100 billion by typing numbers into a computer. Here's the thing. None of them learned how this system really works in school, and neither did you. That gap in knowledge between the people who get how money truly works and those of us who don't, well, it's one of the most expensive gaps in modern life. So let's dive in and try to close that gap.
All right, here's our game plan. We're going to build out the entire financial universe, piece by piece. We'll start with the absolute foundation, this very strange reality of what money even is. Then we'll meet the people and institutions who actually create the money. After that, we'll see the great machine where it all gets moved around and multiplied. We'll even peek into the hidden shadow systems. Then we'll watch it all come crashing down in 2008. And finally, we'll look at the next evolution of money that's being built as we speak.
So before we can even begin to talk about banks or the stock market or any of that stuff, we have to start at square one. And believe me, the foundation of our entire economy is way, way weirder than you probably think. Let's just get this out of the way. Money isn't real. And I don't mean that in some kind of philosophical what is reality way. No, I mean it literally. That $100 bill in your wallet, it's made of about 12 cents worth of cotton and linen. The only reason it works, the only reason you can buy anything with it, is because of this powerful, collective belief we all share. It's probably the most successful story humanity has ever told itself. But as we're about to see, that belief, it can be surprisingly fragile. To really get why we invented this whole story, you gotta look at what came before. I mean, think about bartering. It has this massive flaw called the double coincidence of wants. Basically, I need a haircut, but you're a shoemaker. We have nothing to trade. It just grinds society to a halt. So we came up with commodity money, stuff that has its own value, like salt in ancient Rome, which is actually where we get the word salary. Then came coins, then paper money, which for a very long time was tied to how much gold a country had. But then we get to the single most important date on this entire timeline, 1971. Just like that, with one single announcement on a Sunday night, the entire nature of money changed forever. Before this moment, a US dollar was technically just a claim check for a tiny amount of gold. But after this moment, the dollar, and pretty much every other major currency, wasn't backed by anything you could touch. It was backed only by the full faith and credit of the government that issued it. This is what we call fiat currency. It's Latin for let it be done. The government just declares it has value, and we all agree to go along with it. Okay, so if money today is really just a promise that's backed up by our collective belief, that brings up a really interesting question. How much of this stuff can you actually hold in your hand? I mean, think about all the money in the entire world. What percentage of it do you think is actual physical coins and banknotes? The answer is kind of shocking. Take a look. Only about 8% of all the money in the world is physical cash. The other 92%? It's just numbers on computer servers, digital entries in a database. When you check your bank balance, you're not looking at some vault with your money in it. You're just looking at a digital record, a promise. You have to keep this in mind, because once you realize money is mostly just information, the next logical question is, who gets to create that information? So if almost all money is just a digital promise, that begs the next big question, right? Who gets to make that promise? Who's in charge of the money supply? Well, it turns out there are two main players here. You can think of one as the economy's thermostat and the other as its engine. So on one side, you've got the central banks, like the Federal Reserve in the US. These are banks for other banks. You and I can't open an account there. Their big job is to be that thermostat, steering the whole economy by setting interest rates. Then, on the other side, you have the commercial banks. You know, your bank. They serve regular people and businesses. But their most important job, and the one most of us never learn about, is that they are the ones who create most of the new money we use every single day. And they do it by making loans. If you want to understand the sheer power of a central bank, just look at this chart. When just changing interest rates isn't cutting it, they have this tool called quantitative easing, or QE. That's basically when they create new digital money to buy things like government bonds. And as you can see, after the 2008 crisis and then again during the pandemic, the Fed's balance sheet just exploded. It grew by almost 10 times. I mean, that's an intervention bigger than the entire economy of Japan. Okay, hold on to your hats, because this is where things get absolutely nuts. The old way we were taught banking works was called fractional reserve. Banks had to keep a fraction, like 10% of your deposits. But in March of 2020, the Fed dropped that requirement to zero. That's right, zero. Today, U.S. banks are legally required to hold exactly 0% of your deposits in reserve. The truth is, banks create new money when they make loans. When you get a mortgage, the bank isn't giving you someone else's savings. It's typing new digital money into your account that didn't exist 5 minutes earlier. The loan literally creates the deposit.
All right, so we get what money is, and we know who creates it. Now we're stepping inside the great machine itself. The markets, the institutions. This is the arena where trillions of dollars get moved around the globe every single day. This is where the big players, corporations, governments, and the super rich make their moves.
Investment banks are kind of like the high-powered plumbers of this whole system. And to see what they do, let's just look at a crazy scandal. So Malaysia's National Wealth Fund, 1MDB, needed to raise cash. Goldman Sachs put the deal together. But out of the $6.5 billion they raised, a mind-blowing $4.5 billion was just stolen. It was used to buy things like a $250 million yacht, Picasso paintings, and, get this, in the most ironic twist ever, a stake in the movie The Wolf of Wall Street, a film about financial fraud. Goldman ended up paying billions in fines. It's just a wild example of how the system works.
Now let's look at the two biggest public markets. Stocks are pretty straightforward, right? You're buying a tiny piece of ownership in a company. Bonds, on the other hand, are different. A bond is basically an IOU. You're lending money to a company or a government. Now, stocks get all the media attention, but here's what's crucial to understand. The global bond market is way bigger and in a lot of ways much more powerful. When bond investors get nervous, it affects the cost of borrowing for absolutely everyone, from entire countries down to the rate on your mortgage. And within this machine, you have these specialized players. You've got hedge funds. These guys use really complex strategies and a ton of borrowed money, that's called leverage, to try and make money whether the market is going up or down. Then you've got private equity. Their game is different. They buy whole companies, load them up with debt, and try to sell them for a huge profit a few years later. And finally, you've got venture capital. They do the opposite. They pour money into brand new startups, knowing that most of them will fail, all in the hopes of finding that one giant 100x winner that pays for everything else. So everything we've talked about so far, it's more or less out in the open. But now we're going deeper. We're going into the hidden layers, the shadow structures that hold trillions and trillions of dollars and, frankly, pose some of the biggest risks to the whole system that nobody ever talks about. So what do you think is the most powerful investment vehicle in the world? It's not a hedge fund. It's insurance. See, insurance companies collect all our premiums up front, and then they get to invest that money, sometimes for decades, before they have to pay out any claims. That giant pile of cash is called the float. And this is where Warren Buffett's genius really comes in. He realized he could use this float as a massive pool of investment capital that cost him basically nothing. It's the rocket fuel that built his entire empire.
Another one of these giant hidden pools of money is pensions, that promise of a secure retirement. But that promise is getting pretty shaky. In the U.S. alone, public pension funds are short by more than $1.4 trillion, and the system is incredibly fragile. In 2022, a simple budget announcement in the UK sent bond markets into a panic and brought nearly 90% of the country's pension funds to within hours of going completely broke. Think about that. A single political speech almost obliterated an entire nation's retirement savings overnight. Okay, this next number, this should really make you pause. Shadow banking is the term for this whole universe of financial firms that act like banks but aren't regulated like them. And as you can see, the amount of money in this shadow system is now significantly larger than the entire traditional regulated banking system. It's like a parallel city built with no building codes and no fire department. In good times, it's great. But when a fire breaks out, the flames can easily jump over to the city next door. And that's pretty much exactly what happened in 2008. So everything we've covered, how money is created, how it moves, all that hidden risk in the shadows, it all comes to a head right here. See, the 2008 financial crisis wasn't some freak accident. It was the system working exactly as it was designed to, and then collapsing under its own weight. Let's walk through exactly how the whole machine just broke. So let's break down this chain reaction step by step, because it's so important to see how one thing led to the next. First, the Fed cut interest rates so low that big investors couldn't make any money on safe stuff. This created a desperate hunt for yield.
That hunt led to a massive housing bubble fueled by incredibly risky liar loans. But the banks didn't care. They just bundled up all these terrible mortgages into things called mortgage-backed securities and sold them to investors all over the world. Then they took the absolute worst parts of those bundles, repackaged them again, and somehow got the rating agencies to stamp them with a perfect AAA rating. To top it all off, AIG sold billions in insurance on this toxic waste without having any money to actually pay up. So when house prices finally started to fall, the whole chain just snapped.
And here's the part that I think really made people angry. Just look at the aftermath. On one side, you had 6 million American families lose their homes. On the other side, the bankers who caused it were, for the most part, fine. They kept their bonuses, they kept their jobs. Worldwide, only 47 bankers went to jail for a crisis that wrecked the global economy. It was a pretty brutal lesson in who the system is really designed to protect. Okay, we've seen how the machine breaks, so now let's look at what's next. Because the next great evolution of money, it's not some far-off sci-fi idea. It's already happening. And it might just be the biggest change to money since we left the gold standard. I'm talking about Central Bank Digital Currencies, or CBDCs.
A CBDC isn't like Bitcoin or Venmo. This is the actual dollar or euro or yuan in a purely digital form issued directly by the central bank. And that analogy on the slide, it is absolutely perfect. Think of it like this. It's like we're all upgrading from paper mail to email. Sounds great, right? Except this is an email system where the post office can read every message, block any message, and even set your messages to self-destruct if you don't read them in time. China's already testing a digital currency where stimulus money has an expiration date. It's a huge trade-off, incredible convenience, but at the potential cost of all of our privacy and control.
So there you have it. From the simple idea of money as a shared story, to the complex machines that move it, to the shadow systems where the real risks lie, it's all one deeply connected system. It's like a giant game of Jenga where nobody can see all the pieces. And it wasn't designed to be fair. It was designed by people who benefit from its complexity. But understanding it, even a little bit, makes you harder to fool. That knowledge is a form of power. So the real question isn't about the system anymore. It's for you. The system is a game with hidden rules. Now that you know them, how will you play?